Good day and welcome to the ADM Agriculture YouTube channel. My name is Nico Papworth and this is the ADM Fertiliser Market Report for the UK. We're going to just look really today at the main commodity moves we've seen this week, and then I think it's important at this stage to give a brief sense of some of the implications of CBAM as we see it moving forward, and continue to keep you updated on that. Before we start, if you'd like updates like these from Freddie, Chris, Will, myself and the rest of our trading team, please do hit the bell icon next to the subscribe button to receive a notification every time we make a new upload. Admin out of the way, let's just start by looking at the market as a whole. Since our last videos, global nitrogen markets still really front and centre here, driven particularly by India's highly anticipated urea tender through NFL for 1.5 million tonnes, which was a greater volume than many really expected, closing 19th of December. The tenders really triggered quite a sharp price rally across key exporting regions, with Egyptian FOB values climbing pretty dramatically. We await to see what the fallout of this is. We've of course seen two fairly recent tenders from India, just over 1 million tonne, 1.028 million tonne, and a 560,000 tonne vessel, which actually failed to support the market in the longer run. So we await to see what happens here. I feel this may be different. There's a lot more pressure on the market at this stage, and there's a lot more seasonality coming into this play now. So more people are going to be needing to buy. You look at Europe; it's got a reasonable amount of nitrogen to buy still. So I think there's a bit more at play here. Urea from Abu Kir and Mopco's traded as high as now $390 a tonne FOB for January loading, which is a pretty significant rebound from really what we're seeing in mid-November, which is sort of that mid $350 a tonne FOB mark. Whilst the Indian tender has provided some support to the urea market, China does still remain absent from this export market, with restrictions on new export, which is still in place since the 7th of June this year. This absence continues to limit really global supply flexibility, which I think is going to amplify any upward price momentum we see, and is going to keep the market on edge. They're currently in a stock building situation. Their storage in that country alone sits at north of 8 million tonnes. Really to protect their own producers more than anything else, ensuring they've got supply. So if we do see that coming back into the market, and if that is late Q1, Q2, then that's going to put some pressure on now at that point. In Europe and the UK, nitrogen markets are really grappling with this tightening availability story and rising replacement costs. UK AN market has seen widespread withdrawal, as we have seen with urea, really since sort of Friday the 6th of December, really, with importers generally being forced to begin recalibrating prices to align with this global urea rally, and some of these elevated European production costs. Price increases of £10 to £15 a tonne delivered on farm have emerged. I think it's important to note, though, UK nitrogen stocks on farm still remain quite behind what we'd usually expect to see at this time of year. Current availability is estimated to cover around a 9.8 million tonne wheat crop, as really as an example more than anything else, which is significantly below expected demand for a 14.4 million tonne harvest. I think it's important to note in this data there is regional discrepancy. There's circa 38% of the market to buy, with around an 8% stock rollover from last year. So I think my message from this would be, I'd urge growers who are within this threshold with a reasonable volume remaining uncovered to consider this certainly pre-Christmas or early January. As whilst product is undoubtedly going to be available, there is still some significant potential for that range to become increasingly limited if this pressure remains on a lot of these European producers, particularly on this AN side. Just an interesting piece, but I think before we look at CBAM now, and this is the Affordability Index. So looking at crop price and fertiliser price and the affordability itself. So we've seen the crop price index over the last month drop 2 points, fertiliser price index dipped by 1. However, this is 13 points higher than it was at this point last year, and this is due to a 20-point decline in the crop price index. For me, this is really saying we need to look closely at break-even ratios and start considering that piece, and understanding actually what is the relationship between the input and the output more closely. Fertiliser price index actually at the same level as it was last year ago, despite some nuance and some changes in the actual components itself. Urea and DAP price increases. Indices are now 8 points higher than they were a year ago, while potash is 9 points lower. Currently, this index sits at around a 93, which for reference through the period 2003 to 2012, the average was 100. Interestingly, I think this is an interesting piece. DAP is an outlier here, and this premium is expected to persist really for the next 2 years at least. And whilst we see these levels, it's likely we may see increased investment in this space, which eventually begins to put some pressure on. It's unlikely we'll see this reflected in the market price until sort of late 2020s, but I do think that's something to consider. Now let's jump onto the bigger piece today here, which is CBAM itself, Carbon Border Adjustment Mechanism, and by which we will end up touching on RED III, the Renewable Energy Directive, and the ETS, the Emissions Trading Scheme for Europe. Before I do dive in here, it's important to say we still personally have a lot of unanswered questions on the full impact this will have, but we will continue to try and endeavour to keep you in the loop as we learn more over the coming months. The Carbon Border Adjustment Mechanism, CBAM, is set to heavily impact the nitrogen fertiliser industry in Europe, given the significantly carbon-intensive nature of nitrogen fertiliser production. Urea, ammonium nitrate, to a lesser extent, NPK compounds and DAP are at risk. As we've discussed previously, European production is already facing pretty significant headwinds from rising raw material costs, making this an increasingly challenging environment really for these producers themselves. Industry estimates suggest that between 20 and 40% of European ammonia capacity will be closed by 2030, which to me highlights the region's vulnerability as a high-cost producer with heavy exposure to this EU ETS scheme. Here's on your screen here is a table showing the timeline. Just to take away a couple of key points here, I think. By 2026, importers are going to start to see a significant cost increase due to CBAM implementation, which will eventually need to be passed down to the growers. And by 2034, most of these free allowances under the ETS will be phased out, which is going to further drive up production cost. Now, whilst CBAM doesn't pose an immediate term threat to urea markets in Europe, at least for the next 10 years, it does underscore the potential for a shift in nitrogen source, particularly AN, where there is significantly greater scope to reduce some of these carbon footprints. And I think it's important to touch on some of these alternatives as well, because we are starting to hear some of these terms bandied around. So, I mean, looking at green ammonia to begin with, I think that solution seems to be stalling. There was some quite key conversations to be had in production-wise this year and early into next year that don't seem to have led to quite what we were expecting. So those conversations are starting to stall. I think, pretty high hopes, but little progress. I think the industry really is going to need some pretty substantial supply side subsidy to make green ammonia a viable and cost-effective option for this space. On the other hand, blue ammonia, I think, holds far greater potential. It comes at a far smaller cost premium compared to grey ammonia and could emerge as a pretty feasible raw material over the next 5 years, especially as we see these ETS allowances diminishing and CBAM begins driving adoption of lower carbon alternatives. Before discussing the direct cost implications for the UK farmer, I think it's worth noting the impact of the Renewable Energy Directive as well. So on your screen here, you'll see the key industrial figures for the directive laid out. So by 2030, 42% of hydrogen consumption in Europe must come from renewable sources, which then rises again in 5 years by 2035 to 60%. However, even really under the most optimistic scenarios, and I stress optimistic, which includes some pretty material shifts in operation, industry projections suggest Europe will only achieve 48% of this target by 2030. So a pretty big shortfall there, which to me is signalling two possibilities. Either greater subsidies required to meet these ambitious targets, or the targets themselves may need to see some adjustment. Now, what does this actually mean on farm? You can see here CBAM effect through the years on urea and imported urea in Europe. For the UK farmer, CBAM, its full scope were implemented today. I stress today, would add approximately £35 a tonne to non-compliant urea imports based on current carbon prices. Upon full integration of CBAM, this figure could rise to £50 to £65 a tonne as the carbon price advances, reflecting the growing cost of carbon in fertiliser market. But when we look at it from an expense perspective, we're looking 10 to 20% cost increase in these fertilisers due to CBAM, combined with some other inflationary pressures, is going to add pretty significant cost to that input profile from a farmer's perspective and ultimately affecting their profitability more than anything else. And let's be honest, this is coming at a time of immense grower pressure as well. Looking at an interesting stat here is actually break-even range. So what is the break-even ratio range? So best possible fertiliser price, best possible sale of wheat, i.e. cheapest fertiliser, most expensive wheat, versus the inverse of that. So what does that actually look like over the last 3 years? So look at break-even ratio range. We're operating between 12.2 in the last 3 years and 3.19. Now, if we look between 2019 and 2020, that range was between 6.07 and 2.72. Just those may be unfamiliar with break-even ratio, just a way of calculating how many kilos of a crop you would need to sell to pay for 1 kilo of fertilizer. So average for the last 3 years, break-even ratio swing 6.51, average between 2019 2020 3.01. So the risk for getting it wrong in the last 3 years sits 2.16 times higher than the 19 and 20 season. I think with all this considered, really the additional pressures facing growers from a variety of sources, my key message and key takeaway for CBAM really is this: the further down the supply chain you go, the greater the potential for unaccounted carbon emissions. So for agriculture, this is a really key concern. In its current format, CBAM creates a situation where non-EU producers of finished goods, in this case crops, can gain quite a notable competitive advantage over the EU-based producer, European producers, facing this EU ETS. This puts European growers at increased risk of losing market share as they are forced to absorb rising carbon costs, while their international competitors remain largely unaffected. While the challenges of extending CBAM to include downstream products are significant and complex, and it's important to note that, not doing so would most likely have a notably negative impact on European-based food producers who are following this scheme. In its current form, CBAM does very little to address these downstream risks, which I think is leaving European ag exposed to a potential competitive disadvantage. But that's some things we need to start addressing. Thank you so much for listening. I trust you all have an excellent Christmas break and very relaxing. I look forward to speaking in the new year. Thanks again.